Okay, so I don't see.
We're just trying to get it recorded, so
Yeah, take the
we
time.
weren't sure if anybody would show up since it's our first one, and so we thought, well, at least we can record it. And
John McGill.
Shut mine off. That could be dangerous.
Could be dangerous. All right.
do you want them to have one of each of these, or are you going to pass them out later?
I'll do one of each, yeah.
Right, you want to do it right in
Yeah,
right order?
might as well.
Excuse me, I know you
Yours
said
looks
there
so
was
professional.
water.
Oh, I'm so sorry.
That's because it's corporate.
You know what? All we have to do is put our info.
That's awesome.
Whoops.
Here's some of the flowers.
Oh, thanks, I appreciate you a lot.
First.
Thanks, son.
Yeah, this is a tripping hazard, that's for sure.
And that's as long as it is, it doesn't get in.
Yeah,
You can come on this side if you want.
Okay.
Over by the flowers.
Okay.
Oh, that's your name, right?
Yeah, right.
You want to do that?
Nope, there, I was just.
Okay.
Yeah, no, that's good.
Okay, make sure I got you in here. All right, Mario, you ready?
Go out, I will go this way.
I got you. I got the. I probably don't even need the the monitor, but don't worry. Joshua and Stephanie.
Correct, thank you.
Now, what's your name?
Jonah.
Jonah. That's. I'm seeing a theme here.
Jonah. And Judah.
And Judah. Wow.
My name's Mary. Magdalene. I think it's very beautiful that I was like, why did you
That's
write
kind of
that?
confusing, huh?
But
And her sister is Rachel Leah.
Okay,
Yeah.
okay, I like
Yeah.
that. I like that.
And Judah.
you drew. I see that. Smart. You guys are so cute. Okay, you're ready to go.
Jonah and Judah. Joshua.
Let's get ready to do our homework.
Oh, that's no fun.
Gotta do it though.
Gotta do it. All right, we ready?
Make sure you listen, Judah. Remember this, mommy. This.
Here we go, now I use my own.
Well, hey guys, my name is Brian Shipley, and I am with the Thomas Real Estate Group with Remax Professionals. And this right here is Jennifer Fiore. She is a senior loan officer with Gill Mortgage. And we're going to partner up and do a short seminar on what it might be to be a first-time home buyer. You know, being a home buyer has always been the American dream. I remember when my parents bought their first home way back in the 80s, and you know, they were so excited about it because it was what everybody wanted to do. But why should you buy a home? That's the question, particularly when we're in unstable times, right? Why would you want to buy a home? And I just put down a few things here on, if you just open up your brochure here, we can just go over it. Why would you want to buy a home? And the first thing is pay yourself. Here's the thing, you're going to pay, unless you've got family who will let you live with them for free, you're going to pay to live somewhere. So either we're going to be paying rent, which is paying somebody else, or we're going to pay a mortgage and pay ourselves for it. And so I say pay yourself for it. Unlike rent, mortgage payments stay the same. You know, you get a fixed mortgage, you know what it's going to be for the next 30 years. And I don't know, but my rent has gone up and up and up over the years. And so you know exactly what you're paying. I think another good point is that you can use leverage to build wealth. We're going to go over a case study here in a few minutes, but you get to use somebody else's money to build yourself equity. And that's that's the way you really want your life to be. I think, you know, you ever rented somewhere and you couldn't change the paint on the walls, you couldn't put posters up or whatever. The nice thing about owning your own place is you can paint your bedroom whatever color you want to paint it, right? You can make it yours. And so, and I think it also helps to create a stable family environment. I remember when we moved to Idaho, I didn't want to buy because we weren't sure what our plans were. So we rented. When the lease was up, they sold it and we had to move. The next year, the lease was up. Like 3 times we had to move in 3 years. That's not a good, stable family environment. And so at least when you have your own place, you know that you can stay here as long as you want to stay here. And lastly, I think that it's important that we can take advantage of the rising home prices. Home prices are going up. You know, there is it has been going up over the last 5 years in Reno. Year-over-year average is 14.3% that homes have gained in value. That's a lot of equity for those who own homes to go up year after year after year. And so there's a graph here with a 30-year housing market. And, you know, everything, it goes up and comes down, it goes up and comes down. But you can see over the last 30 years, it has gone up. There's been a few times, back in 2008, there's been a few times. But consistently, home value goes up and up and up. And so if we can capitalize on that, we can build wealth. And I know a lot of people who have done that. So here's some stats for you. Reno and Spark home appreciation average over however long they've been doing averages is that it's gone up 7.86%. That's pretty impressive. But the last 5 years, it's gone up 14.3%. You're not going to get that in a bank account, CD, or anything else. You're not going to get that. The home appreciation rate for last year, 2021, was somewhere between 24 and 27%, depending on who you ask. That's huge. I mean, that is, in 1 year, that is amazing. And the projection, now, this doesn't mean it's going to, but the projection is that it's going to go up this year 13.9%. So 14% is the projection in Reno and Sparks area that the values are going to go up. And I think that's pretty amazing. Let's talk about rent for a minute, because if you know, this is a first-time home buyer seminar, which means that people that's interested in this are probably renting right now if they're going to be a first-time home buyer. In Reno, an 857 square foot apartment. Now that's a small apartment, $1,687 a month. In Reno, right? A house, $1,895 a month. Sparks, the same apartment, is $1,687, but the house is $2,400. The average $2,400 a month in Sparks.
Wow.
That's a lot of money over the years, right? So in 5 years, that's $145,000 that you paid for somebody else to build wealth, and we don't get anything back on that. And the thing is that this is assuming that they're not going to go up, which we know it's going to keep going up. Here's a case study for you, and this is why I believe everybody should try to own their own home. This is a case study. Say that you buy a house this year, $500,000. You use an FHA loan, so you're paying $17,500 down on your home, 4%, which is not there yet, but say it's 4%, 30-year fixed. You're going to pay $2,550 a month, which really isn't that much higher than the rent averages in our area. Okay, it is a little higher, but you're going to pay $2,550 a month, which means that after the end of the first year, you've paid roughly $19,000 in interest, $8,500 in principal, $3,000. You paid $30,642 your first month, your first year to live in that house. You say, that's a lot of money, right? But watch this. Home appreciation rate, just to say 10%. Remember, it's projected, the average is projected to be 14%, but we're just going to conservative 10% in 1 year on a $500,000 home. You've got the appreciation rate of 10%, $50,000, plus the $1,750 that you put down, because that's now equity in your house. Plus you paid $8,497 in principal. You have earned in principal, you've earned in equity $75,997 your first year.
So owning pays you.
Owning pays you because you're paying yourself first, right? $75,997 you now have in equity in that house. Now get this, on money you borrowed. Not on money you owned, on money that you borrowed. In 5 years, you would have, this is what you would have in equity, $373,591, roughly, in 5 years. Now, my son, he bought a home in Fernley. In 2013, he bought a home in Fernley, 3 acres, for $95,000. That is now in Fernley worth $500,000, right? And so you can see there that there is just some huge benefits to owning your own home. And I say, well, how do we know it's going to go? We don't know what it's going to do, but just looking historically, we can project that even if there's a dip here and there, that over time it's going to go up and not down, where rent is going to go up and not down as well. So you might as well pay yourself first. There might be some obstacles to get through. And the thing is about the Thomas Real Estate Group and Guild Mortgage is that we're not just here to try to get you into a home today. We'll work with you for the next year, the next 2 years if we have to get you in there and get you qualified. But I just think that that when you really look at the numbers, there's no reason why everybody who possibly can shouldn't be working to get their own home. Now, you want the facts and the figures? I know you do. That's not me. That's Jennifer. So I'm going to turn it over now to Jennifer Fiore. She is awesome. Every time I have a question, she answers it. She knows what she's talking about. She's great with all of her clients. But she is the professional. She is the senior loan officer at Guild Mortgage. And so she knows what she's talking about. So Jennifer, take it away.
Thank you. That's Brian. That is all great information. I like the way you look at how much you're going to actually earn by owning a home. Because a lot of people don't look at that and take that into consideration. So that was really important. So FHA loans are usually referred to as first-time homebuyer loans. You don't have to be a first-time homebuyer to utilize them, but the reason that most first-time homebuyers use them is they're easier to qualify for. You can have a lower credit score, lower down payment, and they're not as conservative and tough to qualify for as, say, a conventional loan. So I'm going to kind of run you through some basics for FHA, what it is, if it works for you. Most people it does. We're going to go over mortgage insurance and exactly what that is and how that applies to your monthly payment. And then I'll give you some information about Guild as well too. So for an FHA loan, like I just said, one of the main pieces that is so important is its minimum down. So 3.5%. You can do low down like that on a conventional loan, but conventional loans can be tougher. So my job is to show you a borrower options. So if you qualify for various programs, we're going to show you all of those programs, what the payments look like, what the down money out of pocket looks like, then you decide which way you go. But again, most people will start with an FHA loan. When I bought my first house, I did an FHA loan. And I did it because I could do the 3.5% down. It's flexible, like it says here. It's not as conservative, so they're a little bit more open to give an approval. Amazingly enough, just last year, they said you could go as low as 540 on credit scores, which is pretty amazing. So you do have to put a little bit more down if you're in the 540 range, but you can still do that. So, and then you can also ask for the seller to pay some of your closing costs. Now, that depends on every house in the market and if the sellers are willing to do that. But under FHA, you technically could ask for 6% in closing costs. You shouldn't have 6% in closing costs. That seems very high, but you could always ask the sellers to potentially assist. So that would just reduce your funds out of pocket. Low to moderate income, it doesn't have any income requirements. So there are some programs out there, some grant programs in the area that you might qualify for. We can always sit down and look at those, see if you do qualify for them. Those do have income limits and requirements to them, but FHA does not. And again, low credit score and low down. You can do a fixed 30-year rate. Most people do. Nobody really wants to touch an adjustable. The difference between a fixed rate and an adjustable is the fixed rate, whether it's a 15, 20, or 30-year term, that interest rate is fixed for that amount of time, which means your payment's not going to change. There's not going to be any surprises. You're not going to have it jump all of a sudden 3 years later. Whereas on the adjustable rate mortgage, which is the ARM, it's fixed for 5, 7, or 10 years. What that means is if you're fixed at a 4.5% rate, let's just say, for the first 5 years on a 5-year ARM, after 5 years, all of a sudden that rate can jump, which means your payment can jump. It's pretty volatile. I don't ever suggest to somebody to do an adjustable rate mortgage. That was part of the problem back in 2008 that caused the housing bubble to kind of burst. A lot of people did adjustable rate mortgages. The fixed 30-year rates are so incredibly low right now, you're better off just doing a fixed rate, but it's an option. They do have specific products for disaster situations, a renovation loan where you can renovate the property. That's a big deal right now when you're out looking as a buyer, because if you find a home that's in your price range, but it needs some work, you might be able to buy that home under a renovation product where you can build in the cost to redo the kitchen, the bathroom, the flooring, the paint, the roof, in the purchase transaction. And you don't come out of pocket that money for the rehab, it's actually financed into the loan. So that's a nice little feature that they do. You can buy condos under an FHA loan. They're a little tougher simply because the condo has to be on the approved FHA list. In order to be on that list, they have to have a 51% occupancy out of all of the units. So if you have 300 units, at least 150 of them have to be owner occupied. They don't want to do an FHA loan on a condo division that's mostly investors. So, but you can still do it with condos. And then obviously single family. So all these 203K, C, Bs, they're not really going to mean anything to you. Those are just the codes for FHA, but there are multiple ones available. So mortgage insurance. Mortgage insurance is a requirement on any loan if you don't have 20% down, which, let's be honest, first-time homebuyers don't have 20% down, right? Unless you have a rich uncle or rich family member who wants to gift you some money, you're not going to have 20%. So what they do is they add in two types of mortgage insurance on the FHA loan. One is called monthly, and it's set at 0.85 for everybody. And that's included in the monthly payment along with your property taxes and your homeowner's insurance. So when I tell you this number is going to be your monthly payment based off this specific price, that includes all of that in there. They also have an annual upfront fee that they finance into the loan, and it's about 1.75%. So the loan amount is a little bit higher, but you don't have to come out of pocket and pay that annual one-time fee. You can. I've never in 18 years had anybody say, yeah, let me pay some more money and pay that up front. They just finance it in the loan. But there are two forms of mortgage insurance on FHA. I told you when I bought my first house, I bought FHA. So the nice thing when you buy FHA is you're not going to be stuck in that loan forever. The idea down the road, as that home appreciates, like he was talking about, is you want to get out of the FHA and go to a conventional, then remove this mortgage insurance so your payment drops. So it's kind of a two-step process, and that's what I did when I bought my first home. Started with FHA. A couple years later, after I got the equity that I needed, went in, refinanced, got a conventional loan, and dropped my monthly payment. So there's ways to get away from that mortgage insurance down the road. So big things when it comes to, are you ready? Obviously, yeah, you want to stop paying somebody else's mortgage and investing in them. You want to invest in yourself. The biggest things we look at as lenders for any loan is going to be income, assets, credit. So when it comes to income, the biggest thing we need is a 2-year job history. And you can have gaps. There can be gaps in there. It depends on what the gaps, how long the gaps are. But we do need a 2-year job history at least, collectively. When it comes to assets, we're going to look at bank statements to see what funds you have available for your down or your closing costs. They go a little further on those bank statements. What we're really doing is sourcing and seasoning any money that you're going to be using to come to the table. Because we have to make sure somebody involved in the transaction just didn't give you money to buy this house, because sadly some of those things happened back in 2008. So we're going to really be paying attention of what large deposits went into your account. If there was a large deposit, is it cash? If it is cash, there's ways we can work around it, and sometimes there's not. A big question we get in this area, because everybody does it, I have cash at home. Can I use that for my down payment? No, you cannot. Now, there are ways we can utilize that cash, so that's going to be a conversation we would want to have, and I can explain how we do that, okay? But in the end, as long as your debt-to-income ratios are good, we've
Are you here for the buyer seminar?
shown.
Are you here for the buyer seminar?
No, am I supposed to like this? Or
No, that's okay. Thank you so much.
you're so welcome.
So
you guys recording? I'm interrupting something. Hi.
Hi, how are you?
Good, how are you?
Good.
Hi, kids.
So when it comes to, I lost track of where I was. When it comes to funds and qualifying the income, the assets, we're gonna wanna just document it, right? Pay stubs, W-2s, bank statements, that kind of stuff. So usually where we start is we sit down, I gather all the basic information, take a loan application, get all the details, run credit, see if our numbers are in line. Now, sometimes people start and they might not be approved right out of the gate. And like Brian said, there's plenty of clients that we have worked with for years, fixing credits, or waiting for a different opportunity that came along for higher income to qualify, that those people now own homes. So I don't ever want somebody to think, well, if I go in and I do this work and I get her this stuff and it doesn't work, just give up. No, because my job is to say, how do we get to that next step? What do we need to change or adjust or tweak credit, what have you, to get you where you need to be? So lots of options, quite honestly. And my job is information, so that's what we're here for. Guild Mortgage, give you a little background. So like I said, I've been doing this 18 years. I've been with Guild, be 9 years next month. I love Guild. I've worked at a couple different places, worked with Wells Fargo, worked with a different brokerage. I will be with Guild until the day I retire. I will not go anywhere else. And the big reason for that is Guild is local. Guild's been around for 63 plus years, but they're local, meaning underwriting, processing, they're all here in town. That's so important because if I need something as a loan officer, while we're moving forward on your purchase and I need to get a hold of an underwriter, I'm not just sitting in line like when I was at Wells Fargo waiting, and when they get to me, they get to me. We have direct contact with their underwriters, so we can call them, IM them, message right away, and get some movement. That is super, super important. Guild is #1 in this market for purchase loans, so we do most of the business on purchase. But I also love the culture. Everybody at Guild, they're just amazing people. So we did just this last year get ranked #1 in customer service. So for us, we want to make sure that we are at least a 95 or above every single year. So customer service is a huge deal. I personally have 3 assistants that work under me. 2 of them are licensed. The beauty with that is if you need to reach me and I'm in a meeting, one of them can answer questions. We'll call you back. So we are on top of our messages, make sure we respond ASAP. So I'd be happy to sit down with you after this or set up another time, kind of get started, go over everything. Ask as many questions as you can. I love questions, and there is no such thing as a stupid question either. You're investing in yourself. You're buying something that is probably going to be the biggest investment of your life. Make sure you ask questions. Make sure you understand everything you're looking at. So I appreciate you guys coming today.
Yeah.
That's it though. Pretty simple.
Let's go over some questions.
Yeah, let's do it.
Do you guys have any to start?
Yes.
Good, yes.
I love how you guys are taking notes. I love that.
From earlier, he was talking about the equity in the home.
Mhm.
So I'm wondering, what can you do with that? Like, say everything goes perfect on the loan.
Yeah.
You did get this $75,997.
Yep.
Can you use that to pay back
You can.
your loan?
So you can pull equity, you can pull some of your equity out of your house down the road, right?
Okay.
A lot of people will do that right now, or a lot are doing it right now to pay off a higher interest 22% credit card, pull out 10 grand over here that only changes their payment $50 on their mortgage, but use that 10 grand to pay off this $10,000 credit card that they're paying $200 a month on. Now they just saved $150 a month. So there is a way. They don't let you take all of the equity out.
Right.
You are limited to 80% of whatever that value on the market is that day.
Or what a lot of people are doing is they're using that to upgrade to a different house.
Yeah.
So you can sell the one you're in and use that equity as a down payment on, if you're looking for a move up home.
Yeah.
He's fine. He's not.
He's
really
okay.
anything.
Yeah,
He's
fine.
definitely
No worries.
okay. You wanna help me? He's a movie star.
Yeah, absolutely. Absolutely. He's fine.
Leo. And then I had another one, which is just like best ways to keep equity up during your loan, the time of your loan. Like, that's why people change their kitchens and stuff like that. Are they trying to guarantee a certain number?
They're investing back in the home. I mean, you gotta be careful with what upgrades you do.
Okay.
You never wanna have the best house on the market, I personally don't think, because you might have overdone it, right?
Got it.
But it is always smart to use some of your equity to invest back into that property, because then you can increase that value, so.
And that's a good time to reach out to a realtor
Yeah.
who can help advise you on, because some people think, well, if we put in a $50,000 swimming pool, it's going to increase our value $50,000, and then it increases it $8,000, and they're like, well, what the heck? And so there's some things that will increase more value than other things.
And people don't want swimming pools, like, oh.
Right,
Well, they're
right.
not real common out
Right,
here,
right,
so
right.
it's tough to really get that 100% return, so.
Yeah,
Kind of like solar right now, it's just
Exactly.
not
Right.
popular enough.
yeah.
So far, I mean,
I have a question on here, if I was to come in, how much? I think they're trying to say how much you need to purchase with the FHA grant. So we talked about the grant that covers the down payment or could cover the closing costs if we don't ask the seller for any money. Typically, what would they need to be prepared to spend?
To spend, I don't
Maybe on
understand.
Well, so
closing
think
costs.
of down payment, closing, appraisal. What
Yeah,
can somebody
so-
expect?
It's a moving target,
It is.
because
Yeah.
are we talking a $300,000 or a $500,000 purchase price? All of those things change those numbers. When it comes to the grants themselves, they will give you up to 4%. They used to go up to 5%, but they just took that away. So they will give you up to 4%. So if your loan amount's 200,000, 4% is $8,000. Okay,
And what can you use that for?
down payment or closing cost. It won't
So you
cover
can
both.
use it for part of down payment.
So if you were, give you an example, coming to the table with $20,000, which included the down payment and the closing costs, and you got the grant for $8,000, now you're only coming to the table with 12. Does that make sense?
So you
Because the
could use
grant's
that
coming.
then, the grant for things like the appraisal.
Those are all part of the
inspections,
closing costs.
all part of the closing.
and then the seller can assist on what portion of that was said earlier?
A maximum of 6%. So
Okay.
sometimes what we see people do is they go and get the grant to help with the down payment, the 3.5% requirement, and then they ask the sellers to help with concessions. You just really gotta lean on your realtor, because they're gonna know from one house to another, is this house just hitting the market 2 days in, and they're probably not gonna accept concessions, they don't wanna pay any concessions?
Right.
Or has this property been sitting around for 60 days, so maybe they're incentivized to pay some concessions. So that's where your agent's gonna be really important.
Yeah, concessions are tough right now.
Yeah.
Just because the sellers own the market, concessions are, but that changes.
It does.
And what's concessions, like?
That's when the seller helps you pay closing, right?
Okay.
But right now, we've been having really hard time getting sellers to want to do that, because their homes are selling so quickly. But when the market shifts and they've been on, and so say you had a home and you listed it, it's been on the market for 6 months, you might now be willing to pay a little bit to get that thing sold.
So
And
how you
so-
wanna look at it is, so let's say I'm the seller, and you come in and offer 350,000 with 5,000 in concessions. That means that my net is gonna be reduced by 5,000 to cover 5,000 of your closing costs. But then another buyer comes in, same offer, 350, no concessions. As the seller, I'm probably gonna accept that
Yeah.
offer because it's 5,000 more, because I'm not paying for any concessions. Does that make sense?
Okay.
So,
And it's all about profit.
yes.
And Connie or Charles or Isabel, Angela, any of you guys want to come on camera and ask some questions, please let me know.
I got a few here to ask you.
Yeah.
How long do you have to keep an FHA loan before you can refinance?
6 months seasoning, and that's across.
Oh, really?
all
6
loans.
months?
6 months.
Wow.
Any loan, they want you to have 6 months of season
Okay,
before
but
you can refi.
grants are different, right?
Grants are different. So grants, they like to sell them as free money. Well, nothing in life is free, guys. So there's catches to these grants. 3 catches to be exact. First catch is, if our going market rate today is 3.875, their interest rate is 4.375. It's usually a half a point higher, okay? So your payment's gonna be higher. Catch 2 is they also have fees, added fees that you wouldn't have if you didn't utilize the grant. So if they gave you $8,000, back to that previous example of the grant, they're really gonna eat up about 2,000 of it with their own fees, so you're only getting 6 of it, okay? Final catch is that 8,000, they're gonna put a silent second behind your FHA mortgage on title for 3 years. That's gonna sit there, and they call it silent because you don't make payments to it, it just sits there silently. If in that 3-year period you refinance that property or sell, you will pay a portion of that 8,000 back. It goes down every month, so if you're halfway through, you're only gonna pay 4 back. After 3 years, they will come in and remove that and forgive that, and you never have to pay it back. So there is kind of a prepayment penalty in a way on those grants that you might have to pay some back in that first 3 years.
But if you're there, gonna be there for 3 years, basically it's free money, except for
Except
your
for the
interest
higher rates, exactly. So, and the reason they did that.
How much would, so say just go 500,000, because that seems to be kind of the bottom line here, Reno.
Right.
What would that difference in interest be on a monthly payment?
Could be about $200.
$200 a month.
Yeah.
So it might not even be worth getting the grant then.
And that's what part of my job is. I'm gonna show both, like when people want the grants and they qualify and they fit all the parameters for them, we're gonna show you both. We're gonna show you, here's what your payment would be and on the grant, which is gonna be higher because that higher rate, but then the funds out of pocket is gonna be lower. Then we're gonna show you the regular FHA with the lower payment, but higher funds out of pocket. Then you get to decide, I like this option or I like this option.
So for somebody who need that to qualify, it would be worth paying the extra.
Yeah.
Particularly if its projection increase is going to, you're still going to make a profit at the end of the year anyway.
Yeah, these grants are really supposed to be utilized for people who don't have money, right? So if you don't have any money, that's the whole reason they've created them, is so that you can still be a homeowner as well. But if you have your own money for the down payment or the closing costs, even if you have it in a 401k, right now we're seeing a lot of people that would rather invest in themselves, borrow from
Right.
themselves, pull money out of their 401k instead of using the grant, because then they get that low rate and they just pay themselves back
Pay
on their
themselves back.
401k.
See that
So there's a
happen.
lot of ways you could do it, but if you truly don't have a 401k, you don't have any family that can gift you money, you don't have enough funds, that's the purpose of the grants and what they're for.
How long do you have to have a 401k to pull from it?
Each one's gonna be different, it depends on how long you've been vested, which you should be, and what's fun about that too is you should be able to call them and ask, this is my balance, how much could I pull out? Can I pull it out in a loan or can I just pull it out? Am I gonna have any tax consequences or interest, right? Most 401ks have something called a hardship withdrawal. I don't know why buying a home is considered a hardship, but it fits in a lot of those to where you don't have any penalties and no interest. So you just have to make that call and ask them.
Could you recommend any place to go through other than with your employer? Can you select which company you go through? with your
Well, she's
employer?
talking about if you've already got
If
a
you've already got a
401k that you've been
401k, like
putting
your
money into.
employer you've been putting money into it on a monthly basis.
Yeah.
It just
right?
rolled out.
It's your retirement plan.
Got
Then you can call, like, it's mine, I think is, I forget what it is, but I would call them and say, how much can I pull out? And what are the terms and what are the consequences, if any?
So yours just started?
Yeah, like I
Okay.
just opted, but they don't have the Roth IRA, so I don't know if I should just go to a separate person that offers that one, because we just have the traditional.
So you would,
401k.
you would wanna call the one where the money is sitting.
Okay.
You would wanna call them and ask those people,
Okay,
can
Yeah,
I pull
would make
out
most sense.
any money or
Yeah.
can I not? And if they may come back and say, no, you're not vested long enough, you have to be vested 2 years or 5 years, right?
So you mentioned gifts. Can somebody gift on an FHA, can they gift you money for the down payment?
Yes,
And
they
is
can.
there a limit?
No, they can gift you 50% of the purchase, no limit. But yes, you can gift, you can get gifts. You always wanna make sure you talk to your lender before any money moves. FHA is the strictest when it comes to gifts. It wants to see the donor's bank statement so they can make sure a big deposit didn't go in there that might have come from the seller to gift you the money in a roundabout way. So they really need documentation, but if somebody's gonna gift you money, it's possible. We just ask that the money not move because we'll tell you how to move it at the end and make it less of a hassle for everybody.
So if you have some rich relatives, they could help you get into a house.
We're seeing a lot of that right now, a lot of
Do you?
gifts.
no,
No, I don't have a rich uncle either, so yeah.
So if somebody, so say somebody wanted to come in and get, well, first can you explain the difference in what it might mean to be pre-qual or pre-approved?
Yes.
And to get pre-approved, what would you need from them?
So pre-qualified means I've sat down either on the phone or in person. You've told me how much you make. You tell me how much is in your bank account. I pull credit. As long as all those numbers look good and the ratios are in line, I say you're pre-qualified. I haven't done any due diligence to verify the income or the assets yet, which is why it's called pre-qualified. To get to that next step, pre-approved, means now I have to collect 30 days of pay stubs, 2 years of W-2s, and 2 months of bank statements to verify assets. As long as all of those documents back up the numbers I used in your approval, now you're technically pre-approved. You want to be pre-approved, not pre-qualified. I've seen too many times where people get pre-qualified, don't supply any of the supporting documentation, are told that they're approved, go shopping, go get it, they go get in the contract. And then once they're in contract, they supply the documentation to the lender and the lender goes, oh, we got a problem. You're not approved. You don't want to be in that boat. You really don't.
Right.
You want to make sure that you are solid before you go set your house, your heart on a house that you want and you
Right.
get in a contract. So,
Well,
and the sellers really want an approval letter.
Yeah,
They
well-
won't accept a pre-qual letter. They
Yeah.
want a pre-approval letter. They want to make sure we've done our due diligence that you are going to be buying that home.
Yeah.
So,
yeah, it's really, we can't even put in an offer without it.
Yeah.
Nobody will even accept an offer without having a pre-approval.
and sometimes those listing agents, they'll call us lenders. If you made an offer and say, tell us about these borrowers. Now, we can't go over what your credit scores are, is very specific info, but a lot of listing agents will call and they'll grill us a little bit to make sure you're a solid borrower, or are you just at the razor's edge, barely qualifying? So,
Okay, so say we go out and look at a house. And Josh and Stephanie really like the house,
Mhm.
but they're not pre-approved. So I call you on the phone. Is that possible that we can,
Yeah.
from right there, call you, get some numbers and?
Yeah. I always suggest do your homework before you go out looking at houses.
Right, so you
Quite
know what-
honestly, I mean, sitting down and going over everything maybe is an hour. Sometimes it can be done in 30 minutes. So it's not a lot of work. The biggest thing is that paperwork, the pay stubs, W-2s, bank statements, because that's the meat and potatoes for me to confirm everything. So
Okay, what about debt to income?
debt to income, how that works, there's actually 2 debt to income ratios in our industry. There's something called the front end and the back end. The front end is your house payment against your collective income as a percentage. There's
Okay.
really no maximum on that one. Well, you can't go over 56%, but
Now we're talking, well, house payment, we talking taxes, insurance,
everything,
if they have a
HOA.
HOA, okay,
all
okay,
of that's included.
okay.
The back end ratio is the house payment and all your other debts, like if you have auto loan, student loans, credit cards, all of those monthly obligations against your income. FHA has the highest debt to income ratio limit of 55%.
So you can go over half of what
Yeah.
you're owing.
Yeah.
To pay that.
FHA's, VA will do it in some cases as well, but we're talking FHA, so FHA 55%, which is pretty amazing. Because conventional, you're maxed at 50. USDA, they want you closer to the 43 range, so. But on the grants, now if you use the grants are a little more conservative. They max out at 50% for FHA, because they don't want you pushing the limit too far. I get it, so.
Any other questions?
Credit questions, so should I save them or just?
No, that's what we're here for.
My
Yeah.
case?
I can turn these off, just give your information if they wanna reach out to you, and then we can just focus on your guys' private.
Yeah, that way it's not
How would they reach you, Jennifer?
my cell is the best number, 775-338-5059.
And for you, Brian Shipley,
My cell is the only number. No, that's not true, we do have an office phone. 775-350-4212. If you're interested, let us know and we will help you.
Well, thank you guys for joining live. We appreciate it. And we'll take some more questions if you want to comment below and press replay if you are watching this later.
Okay, what's your question? Credit wise?
So I'm almost,